A lot to worry about, and Fed officials just told us to take summer off, basically, that they'll get back together in September and consider what to do. Do you think they need to do something before then?
I don't think they need to do anything before, but I do think that the list of worries is indeed growing. It used to be the case for the last several months that we've been worrying mainly about the trade war. What is coming from the trade war, very importantly, is what Jamie Dimon pointed out yesterday, namely that now we're going to see the negative effects of tariffs on earnings and therefore also on the economy. The Yale Budget Lab is quantifying that the impact on GDP this year will be minus 0.7. Normally GDP growth is 2, so if I subtract minus 0.7, that brings me to still 1.3. That's not a recession, but it certainly is something that will be pushing the unemployment rate up in the same calculation by roughly half a percentage point. So the first thing is tariffs. We are still waiting to see the actual effects of tariffs, both on earnings and on the economy. And the things that are being added now more recently is student loan payments are restarting, is beginning to hit people's credit scores. There's about 9 million people now who potentially will have a hit to their credit scores and therefore will have challenges going out buying a house, going out buying a car, going out buying a washer and dryer. And third and finally, the downgrade. Yes, the market reaction yesterday may be more mild. And yes, we did go from the US being hyper-exceptional to just being exceptional. But it's certainly a risk with the fiscal discussion and in rates markets that we are also adding on to the layer in terms of the issues that we're talking about.
You see this stress in the buy now, pay later data as well, and you've seen that build for a number of months. The question I would ask, the brutal reality is, low-income workers haven't had a good run for a long, long time. That's been true even when people came on this programme and said the economy was good. Do you see the stress migrating up income levels at all?
That is exactly what's going on. So you saw Klarna yesterday say that they were reporting that buy now, pay later was seeing more weakness among consumers. And the issue is exactly that it's migrating up towards middle-income households. You're seeing this also more broadly in, for example, in the housing data. The Sonda weekly data for traffic for home builders is beginning to slow down. And this spring selling season has basically been much weaker than the spring selling season we've seen for the last few years. So also the weakness in the housing market is a leading indicator telling you that the middle-income consumer is also beginning to look more stressed.
So you don't necessarily see recession, but this downside to growth that comes at a time of pricing pressure is something that looks a bit like stagflation. And I wonder, some people say, well, if it's not a recession, then it's pretty good. Is this actually a worst-case scenario for risk assets because there isn't a very obvious reaction function from the Federal Reserve, from policymakers, to respond to the fundamental underlying weakness in consumers?
Exactly, because inflation, if that is now going up, we've heard all the stories from Walmart, now Subaru, various, of course, retailers are saying prices will be moving higher over the coming quarters. That's what everyone expects. This is the textbook definition of a trade war, namely higher prices because imports of containers that come in to Los Angeles, of course, things will become more expensive. And that is exactly challenging the Fed's room for maneuvering because they will have to keep rates higher for longer in response to almost no matter what growth is doing. If growth, of course, gets into a deep recession, they will be cutting. But if growth is just weakening, and that is the expectation from the consensus, that's what we're seeing in the data, then you will have this stagflation situation, which is very uncomfortable from a Fed perspective because inflation higher for longer says the Fed should be hiking, but growth slowing down says the Fed should be cutting. So this becomes a question for the Fed. Do they like apples and oranges? Do they put more weight on inflation being high, or do they put more weight on growth slowing down?
So it goes to something that John was talking about. Jamie Dimon yesterday talking about this complacency in markets, particularly with risk assets, given the fact that, yes, you have these tariffs, but you also have this kind of backdrop that does pressure the consumer. Do you think that risk assets really are not pricing in this type of backdrop at a time when you've seen big rebounds in this wake of any kind of sell-off?
I think the stock market is backward looking at the moment. The stock market is not taking into account the fact that we have these three different forces that are now pushing the economy down. First of all, we have tariffs weighing on earnings, tariffs weighing on GDP, tariffs pushing the unemployment rate up. We have also student loan problems that will hit people's ability to borrow. And finally, we also have the Moody's downgrade. Yes, again, that might just be a thing in markets where we said, oh, this just went and came away and well, suddenly no longer an issue. But it is certainly something that this conversation, the direction of travel when it comes to the fiscal discussion is only one way, namely that we will see debt levels go up. And there's more and more discussion around what does that mean, not only for rates, but also for the dollar. And note also yesterday, by the way, that the dollar went down, even though rates went on a round trip, still telling you that there is something here to think about in terms of the bigger picture, not only in terms of what rates are doing. And then when the dollar goes down, of course, we get even more inflationary pressure, and that complicates the job for the Fed even further.
Torsten, you keep talking about downside risks. Do you see any upside risk to policy proposals right now in Washington?
I do think that the stock markets focus on deals when it comes to trade deals. We do see, of course, that there could be some good chance that we could get some deals, of course, over the coming weeks and months ahead. But the issue here is that the policy has already been implemented. Let's not forget
But it's
that
on pause.
But average tariff rates went from in January 3% to now 18%. So that's a fairly dramatic shock. Remember in 2017-18, in Trump's first term, tariff rates went from 2 to 3. And now we went from 3 to 18. That's a very significant impact, which is exactly why this earnings season gave this outcome that companies are having a hard time giving forward guidance. Companies are having, of course, a lot of challenges with dealing with higher tariffs. That's why Ford Motor Company had losses of $1.5 billion, Apple losses of $900 million. It really is significant how these coming motions of what will happen to earnings and GDP are not being priced into markets at the moment.
In your office, at your headquarters, on the calendar, what's circled? What dates? Which month?
So what's most important is back to the square the circle to what you said about the Fed meeting. It is very important how the Fed communicates about this. So far, FOMC members have said we have a wait-and-see mode because it's fair to say, John Williams said this, and Powell also has been talking about this, it's fair to say let's wait and see what the data actually is going to turn out like. But if I turn on my Bloomberg screen and type ECFC, go and look at what is the consensus expectation to inflation this year, it's going up. What's the consensus expectation of GDP growth? It's going down. As an investor, this should be the number one thing to look at when I do asset allocation. So the answer to your question is the incoming data, does it play out as the consensus and the textbook would predict, namely that inflation is going to go up and GDP is going to go down? And I would expect that is exactly what we're looking at over the next several quarters.
Inflation short-lived or persistent? They say they need time. New York Fed President John Williams said maybe by September. Is that enough time to know whether it's one and not the other?
Well, hold on. So there are two very important aspects of that. Beth Hammack said in a speech here 2 weeks ago at the Hoover Institution that she is already seeing companies that are not impacted by tariffs also raising prices because competitors are raising prices. And the second thing also, let's think about it the following. If it ends up being the case that you will have imports that are significantly lower and therefore you will have less variety on the shelves, that means that I may not be able to buy a white shirt and a right color. And if that's the case, then the price of all the shirts that are left will be going up. So that means that it's not only about this one-time lift in changing the sticker and what is the price of my shirt, but it's also that if there is less variety, if there's less goods coming in, and if we're trying to avoid and prevent goods from coming in, it will mean that the goods that are left might see a more permanent increase in inflation. So that's why this is not just a temporary feature in terms of thinking about inflation. It is something that potentially could have more longer-lasting impact.